Well, good afternoon, everyone. My name is Njavwa Mulwanda. I'm the managing partner of Zenga Venture Fund. Hopefully, everyone got to hear some of the inspiring stories from Java Foods, Rent to Own, and Zambian home loans. Really great to hear and see Zambian businesses raising really almost $6 million is what I heard in financing over the last few years. So what we'll do today is do maybe just a little bit of definitions on debt and equity. I will give a brief background on Zenga and what we do and a background on myself. And then I'd like to really hear from you in terms of what sort of businesses you run. And there's some poll results as a poll that the team has taken or will be taking. And then after that, we can talk about what is right for you. And I think if you heard some of the stories in the lead up, it can be a mix, it can be equity, it can be debt, or it can be not now, but maybe later. And then for me, the most important section of this discussion will be a Q&A. So I'd love to hear from you, love to hear what's on your mind. So a bit of background on Zenga. So we are an emerging merchant bank. We advise, we invest, and we lend in Southern African businesses. We're a team of 12, eight of us based in Lusaka, including myself, and 4 based in the US. We also work with a couple of consultants in London and Dubai. So quite a few different touch points and investor perspectives that I'm hopeful can be helpful to you today. Zenga partners have invested or have helped clients invest or raised capital for clients over $41 billion across 3 continents. We ourselves have invested in debt and equity, either directly or indirectly, a little over $1 million into Zambian SMEs. A bit of my background that again I'm hopeful will be helpful in terms of your considerations. I was born and raised right here in Zambia, proud graduate of David Kaunda Secondary School, worked in corporate finance in the US, in the UK, and in Zambia now for the last 3 years, but in corporate finance for 16 years. Capital raising has been my job for the last 8 years, and 3 of those years in Zambia. I've been an equity investor for the last 4 years with Zenga Venture Fund, myself and 3 other Zambian co-founders, and myself and my partner One in Siska have built a trade finance business more focused on credit over the last year. I also sit on the bank board, which I'm hopeful people have had some positive experiences with banks, but sometimes the experience of an SME with banks, unfortunately, can be not the best. But that also helps the perspective with regards to what other forms of investment are out there. And also I can give some of the pros and cons of debt investment from the banks. I think there's also another couple of sessions today that'll be helpful in that regard. So maybe just some definitions. So what is debt? I'll start with debt first because it's the first to be paid back in the event things don't work out. But effectively, debt gives another party a claim to your future cash flows or to your revenues as a business. In the event of a liquidation, the debt holders get paid first. What are the key features of debt and some of the things you should be thinking about if you're thinking about a debt investment? Interest has to be paid periodically, and importantly, it has to be paid in the currency in which you borrowed. So I'm hopeful again I think specifically in the rent to own story, you heard the entrepreneur say, they got a million euros, but they got it in kwacha and they repay at the time of the investment. So if you borrowed, let's just say $1 million and you borrowed when the kwacha was 10 to 1, obviously a very different consideration if you earn kwacha and now you're repaying when it's 21 to 1. Another important component or feature of debt is that the principal has to be repaid. Right? So in addition to the interest, sometimes there are periodic repayments of the principal, what the banks call an amortization, where you're making even payments periodically, or you make what's called a bullet payment or a lump sum period at the very end. And in some markets, you can refinance. So let's again say you borrow $1 million and you pay 10% interest. So you're paying $100,000 in interest over a 10-year period. And in the 10th year, your balloon payment of $1 million is due, or you can refinance that with another lender. The third feature is that there's typically some sort of security that's involved. So either it's what's called immovable or fixed assets, so a house, maybe some heavy machinery or a warehouse, or some movable assets. Maybe you have some tractors, maybe you've got a very nice car that you can put as security, or in some cases, it's the shares of the company itself as security. So what are shares and what is equity? Maybe let's do some definitions of equity. Equity represents interest in the underlying company or the asset. Equity holders get paid what is left. So after you've paid all your bills, you've hopefully paid all your employees, you've done your NAPSA contributions, you've paid your taxes, most importantly, what's left is what's distributed to the shareholders, and those are in the form of dividends. But the debt holders have to get paid first. A few other features of equity: unlike a grant, which doesn't necessarily have to be paid back, equity does have to be paid back in principle, either in the form of dividends or in the form of, sometimes equity is made in the form of even a shareholder loan. That shareholder loan is paid back at the end, or in what they call capital appreciation. So if you sell your business for X and you had a 10% equity shareholder or partner, whatever X is when you sell the business, 10% of it goes to that investor. The reality at the moment is that pure equity investments, to be honest, in Africa are becoming more and more rare. The majority of investments now are really hybrid securities, or both debt and equity, just to ensure investors get their money back. You might have heard Monica Musonda, the founder and CEO of Njavwa Foods, saying she raised both debt and equity in a $4 million raise. She was telling in a story there. There's a balance there that we'll talk about next. And of course, now you want to ask the important question of this class: which is right for you? Before we do that, maybe I can ask, with help of the moderator, just to display, there we go, just some of the poll results there. So does your business generate revenue currently? Looks like the majority of you is yes. That's great. Does your business generate positive cash flow currently? Majority of you no. That's fine. More optimism. The yeses are growing. Lovely. This is the only answer. And as an entrepreneur myself, I would give the same answer. So the question is, do you expect your business to generate positive cash flows in the next 12 to 24 months? Terrific. Okay. So there's an acronym I want you to remember in terms of which is right for you. The answer, like everything else in finance and economics, is that it depends. It depends on several CREAM factors. CREAM, C-R-E-A-M. The C is for cash and cost. R is for revenue. E is for expectations. A is for availability, what capital is available to you. And M is management. So let's go into each of these briefly. C, cash and cost. Cash, is your business cash flow generating? So most of you said, no, it isn't. If it isn't cash flow generating at the moment, you need to focus on equity as a potential investment, or have a very patient debt provider who can give you a payment moratorium of some sort until you feel comfortable that you will hit cash flow positivity, because it's the cash flow that is used to pay down the interest and the principal. Now, remember I mentioned the cash flow currency. So be very careful of a lower interest rate in dollars if you're borrowing. Also note what the interest rate is when you're getting investment, right? So you're getting equity investment, you don't have cash flow. If an investor, again, has come in when the kwacha is 10 kwacha to the dollar and they expect a 20% IRR, well, if the kwacha has lost 100% of its value, then you need to make sure that the investor is able to get back the money they put in, plus potentially a premium. So be careful of the currency in which you either borrow or the investor invests in, and be clear on what that is. The other C in the CREAM acronym is cost. What's the cost of the capital? If it's equity you're giving up, how much equity in your business are you willing to give up? Are you willing to give up a 50% stake, a 51% stake, a 20% stake? In this regard, this is what makes equity a lot more expensive over time, as you're giving up a share of your profits and your capital appreciation to the investor. In terms of the cost, given this factor, debt is typically cheaper. It's typically cheaper, not always, because once you're done with your obligations, you're done. You don't owe the debt investor really anything else. Unless you default on your obligations, then that security I mentioned would need to be ceded to the investor. So C, cash and cost, R for revenue. So again, most of you said your business generates revenue today. So even if you don't generate revenue, a second check, is your business revenue generating? If it isn't, again, I would focus on equity and patient equity until you can get to revenue. But most of you have answered that it is. So that means you've got a path to cash flow, which then opens up debt investment as well as equity investment. Recently, I've seen equity investors taking a share of revenue as a way to pay back, to earn their return. Or if those of you who've been following the Mopani transaction where ZCCM has bought the 90% from Glencore and FQM that they didn't own, the $1.5 billion is debt is going to be paid back by a share of revenue, depending on where copper prices sit, and some cash flows. So you can absolutely look at the two, share of revenue and some equity. But be very careful because you're effectively paying a cost of service above your costs versus interest, which is sort of below your operating costs. So CRE is for expectations. Where do you expect your business to be in the next 12 to 24 months? What about in the next 5 years? If you're bullish, like most of you are, then you can have a view on what the value of your business is today based on your expectations for the future. We can have a separate discussion or a few minutes in the Q&A if there's appetite for that on how you can value your business. A is for availability. What's available to you and from who? The right partner is important. Hopefully it's an impact investor that you're partnering with. If not, if there's no equity or debt available, then looking at friends and family or angel investors is another consideration. Now, last but certainly not least, M for management. This is the preparedness question. Are you ready for equity or debt investment? Governance, what does your governance structure look like? What does your financial reporting look like? What do your processes look like? And take it from me, who has 11 phenomenal partners. It was very different trying to raise capital as Njavwa Mulwanda Tamanga by himself. It's a different conversation when there's a management team and there's a group of people. Investors get a lot more comfort when there's a group of people that they're backing. The other reason management is important is, if you were lucky enough to start a business early in your career, then terrific. But some entrepreneurs or business leaders are, a lot more experienced. And perhaps there's a question of what's the succession plan? What happens if your partners aren't interested in taking over the business or in stepping in if you win the lottery, you go decide to do something else? So in short, those are my thoughts. What are the cream factors of my business? What's the cash and cost? What is the revenue? What is the expectation for my business? What capital is available to me? And M, management team. Are we ready for debt or are we ready for equity? I'll stop there and maybe turn it back to the moderators to see if you all have any questions. And as we're compiling questions, I see there's a question in the chat room. As we're compiling questions, if folks are feeling shy, we'll deal with those. Okay, so there's a question. There we go. Please give me the cream here directly. Okay, yeah, there we go. Cash and cost, revenue, expectations, availability, and management. Okay. Great question from Deb. You mentioned company valuation. How do you work out what a business is worth? So it's a great question. The key is a business is worth today what its future prospects are, right? So if your cash flow projections are positive, we can discount today what those cash flows are worth. If you don't have cash flows, you don't have revenue, it's a lot more science than art. So again, to give you an example, if you're trying to bring in a partner for 10% of your business and you've decided that equity investment is what is right for you, but you don't have cash flows, so we can't predict what your business is worth today by discounting cash flows. You simply take the amount you're looking to raise. Let's say you're looking to raise 100,000 kwacha and you're willing to give up 10% of your business. 10% of the business, 100,000 kwacha is what you're raising. You simply take the amount that you're raising, divide that by the equity that you're willing to give up. That gives you the value of your business today. Another question, does it matter who or what type of investor I raise money from? Absolutely. So I think the forum here is very focused on impact investors. And so impact investors typically have a triple bottom line, right? Of people, planet, and profit, versus friends and family have a very different expectation. They just want to see Njavwa do well, and maybe they don't have a return expectation. Okay, what do I need to look out for in assessing whether a business is... Oh, sorry, I see it. Apologies. I see there's a hand up from David. David, go ahead.
Thank you so much. Good afternoon.
Good afternoon, David.
I wanted to find out if there is a way we can still be able to connect with you direct and maybe get more information on what you're sharing. I have a lot of questions, but I feel the 30-minute session is less for us as Essential Commodities Limited.
Absolutely. So you can always, thanks for that, David. You can always tweet me at JJ Mulwanda, or you can always email me, Njavwa at zengaventures.com. Aha. How do you, I'll see if there's any other hands. Otherwise, there's a couple questions on the chat.
I think let's take the one from Lance.
There we go. How do you determine what discount rate to use when discounting future cash flows for valuation? Great question. And in what currency? Because the discount rates are very different. So cost of capital, I mentioned one of the C's, right, in our cream. Cost of capital is a combination of cost of debt and cost of equity. Now, if a business doesn't have one or the other, you have to look at the marketplace. Now, the marketplace says you have to look at the prevailing treasury yields over a 10-year period. And you also have to look at the expectation on the equity side. You look at the expectation for minimum required returns in Zambia. And so if you're in kwacha, the cost of equity and the cost of debt, plus the expectation for what investors should return, you can use to figure out what the discount rate is. So you add your cost of equity and your cost of debt, and that gets you your discount rate you should use for future cash flows. The good news is if you do generate dollars, that cost, the discount rate you typically use is between 14 and 18% at the moment. The challenge, however, is that given our macro situation, investors are typically requiring a higher rate of return. So if your business is a kwacha cash flow, the real discount rate to use for a kwacha cash flowing business is somewhere between 40 and 50%. The smaller your business, you're penalized even a little bit more because there's a premium or a discount for the size of your business. I'll give you a quick resource that I'll type here. There's a University of New York University Stern professor called Damodaran, who has a lot of templates that you can go and check for how do I calculate the cost of capital, a lot of templates for discounted cash flow analysis. But the reality is, and this is the challenge with the discounted cash flow, it's so subjective because what's the true lifetime you should forecast? Is it 5 years? Is it 10 years? Is it 15? You should use a combination of valuation factors. Discounted cash flow is one, comparable companies is another. So what other companies are there like yours? And where do they trade on a multiple basis? So on a cash flow basis, where do they trade? Do they trade at 7 times earnings before interest, taxes, depreciation, and amortization? We love acronyms in finance. So EBITDA multiple. And how do you find that out? You have to look at research reports, or you look at where a company is trading. So Zambeef has an EBITDA multiple. If you think your company is like Zambeef, and Zambeef, let's say, trades at 7 times EBITDA, which it doesn't, it should. Zambeef's EBITDA last year, I believe, was $25 million. You can take the 7 times and say, my business generates $1 million of EBITDA last year or next year. I'm going to take that 7 times multiple from Zambeef and add it to my business. You can also use revenue multiples or growth multiples, and especially in the tech space, it's all about growth and the top line. Cash flows don't matter so much. And that's really another feature that I should mention, is that what capital you raise is also highly dependent on what industry you're in. So try to use an amalgamation. Don't just use one approach. If you don't have cash flows to discount, of course, you have to look at other valuation methods. Other questions? Great questions so far. Just looking at the time, we've got 6 minutes. There's a question from Sydney. What is the range of interest rates for debt financing that is secured by an immovable asset? Yeah, so the bank markets are a good example of this. And so an immovable asset is something you can't move, as the definition suggests. So a house or a factory. The prevailing bank markets in Kwacha, the Bank of Zambia facility has helped, but pre-COVID, that was really between 25 and 30%. Blue chips, a little bit less. Emerging companies, like a lot of ours, mine included, would be closer to 30, if not more than 30%. If you're borrowing in dollars, that tends to be between 12 and 16%. But most banks at the moment locally, that's the range. Now, impact investors would take a different view. Some of them will take a single digit rate if it's in dollars, or a mid-teens rate if it's in Kwacha or it's in rands. And that's why, again, this avenue is important, is that impact investors take a different view than just the interest that they charge. So it very much depends on who. I think, as Tuela asked, does it matter who I get my funding from? It absolutely does, because they're going to have very different expectations. More traditional private equity investors tend to want for equity between 20 and 25%, for debt around 16 to 18% in dollars. Again, because of the minimum expected return for the risk profile of our country and our history of currency devaluation. Lance, resource was Damodaran. Resource for valuation templates. Any other questions from folks attending? Otherwise, happy to go to the chat. Some great questions on the chat. Okay, I'm considering an equity investment. How can I put a value in my business if I don't have any cash flows? Okay, I think we've answered that. Look at your revenue projections, especially if you're in tech, and then look at similar businesses and look at where they last raised money or where they're trading. If there's any publicly traded companies in South Africa or in Zambia or in Nigeria, or in some cases even in the US that you can look at, and look at where they're trading from a revenue multiple perspective, and then apply that to your revenues. So let's say you think your business trades like Apple, and Apple trades at 50 times revenue. And I'll explain what trades at means in a second. You take that 50 times and multiply that by your next 12 months. Especially on revenue, try to get investors to look forward your next 12 to 24 months. If you're doing it on EBITDA, it's more your last 12 months. So what have you done in cash flow? What are you going to do in terms of revenue? Okay, so the multiple. So how do you figure out what the multiple is? If you're looking at revenue, you take the market capitalization and you compare that with the revenue of the business. If the business trades at, again, 50 times revenue, let's say the revenue is $1 million and the market capitalization of Apple a long time ago, it's It's $1 trillion now, but a long time ago it was $50 million. You take the $50 million of market capitalization, so divide that by the revenue of $1 million 50 times. You take that 50 times and multiply that by your revenue projection because you think you trade like Apple. Okay, so just to wrap up, which form of capital is right for you depends. It depends on the cream factors. A disclaimer, the cream factors is just my view. It's one view. There's certainly lots of other views out there. There's more academic views, but hopefully those acronyms are easy enough to remember. What's the cash flow profile of my business? What's the cost of the capital? Those are the C's. The R is for revenue. The E is for expectations. The A for availability, what capital is available to me. And M, certainly last but not least, management. Am I ready to take on equity or debt? And sometimes the answer is both. Thank you, everyone, and hope you enjoy the rest of the masterclasses today. Again, tweet me at JJMulwanda or email me njavwa@zengaventures.com. Look forward to continuing the conversation. Thank you and all the best in raising capital this year or next.